if you go back 5 years, 10 plus years, it used to be that the pricing of gold, the pricing of silver was strictly done in collusion between LBMA and the CME, New York and London. But what's happening now is the demand for silver, because it has so many different uses, the tail, meaning the derivatives market, is no longer wagging the dog. The dog is standing up on its own and it's starting to wag the tail. In other words, the cash markets are pricing silver, they're pricing gold, and the futures contracts in New York and London be damned. And that's proven. Just look at the price in Shanghai. Look at the price in Shanghai. Look at the price in India. They're both at a premium right now. Shanghai's $11 higher. In what world could that exist without arbitrage? And the reason the arbitrage is not closing that gap is because if you sell a contract or sell physical metal in Shanghai, now you're short, and you buy it in New York, and if you don't get delivered on, you're short, pure and simple. So the reason the arbitrage, that spread, exists is because, in my opinion, traders are afraid to go short in Shanghai because they don't know 100% positive that they're going to be delivered on in New York. Back in the mid-70s, when they created the futures contracts, they were created, and actually, I just posted this on my site 2 days ago. Data had put out a press release back in 2017 where there was an intercepted cable that talked about the origination of the COMEX futures contracts, and that the purpose was to be able to control and suppress the price of gold and silver. It worked as a relief valve, if you will, on the pressure of physical buying of gold and of silver. Now you can add one more group to one more layer on top of the suppression, and that was the ETFs, GLD, SLV. If you look at their prospectuses, they do not have to own physical gold. They do not have to own physical silver. They have to own, they can own physical metal, but they're also allowed to own contracts. And when this came out in 2003, GLD, and then I think SLV came out a year later or 2 years later, right off the bat, I said, this is a pressure relief valve. It makes it easy for somebody to point and click in their brokerage account and purchase GLD, purchase SLV, and say to themselves, okay, now I'm hedged. I own gold, I own silver. The only problem is that's not true. You don't own gold, you don't own silver, you own contracts. You have a paper conduit to your ownership of the metal. So what it did was it steered what would have been physical buying, cash and carry, you buy it, you take delivery. It took some of the pressure off of that and diverted funds into the ETFs. Now there's one more layer, and not too many people have talked about this, but I fully believe this, that the cryptos themselves were also a pressure relief valve for investors who wanted to get out of fiat. What they did was they've offered another avenue to get out of fiat and into something. I guess when I say something, what is Bitcoin? What are cryptos? In my opinion, they're digital air, and when the rug gets pulled, those are going to be zeroed out. So in the end, you either own physical gold, physical silver, or you don't. If you own the ETFs, you don't own gold or silver. If you own crypto, like I said, I don't know what you own. In my opinion, it's digital air. But all three of those instances were all used to suppress the price of gold and to suppress the price of silver. And oddly enough, gold and silver since January of 2000 have been the best asset class to own.
Yeah, and I think it's so interesting. You talk about ETFs. I mean, it's so good you bring that up because people often take at face value, thinking, "Well, it must be audited, it must be legitimate," and they haven't read the prospectus that you refer to, where it's possible to short sell. So if you can short sell an ETF, if there's a derivative crisis, when the derivative crisis blows its head up, the very reason you bought what you thought you bought gold and silver for was what it should say on the box, which is to protect you. Well, how do you know? You're going to get bailed in to the balance sheet of a bank you've never looked at, who has borrowed silver and can't pay it back. What do you think? What do you think is going to happen to you when you look at that and say, "Hey, bail-ins, we've had bail-ins before. You don't know they're coming. You wake up and and bail-ins, and we talked about this before, Bill. You've been talking about it for years. Bail-ins are everywhere. They're sanctioned to be everywhere on this globe, Western globe. So people don't think about what you're just talking about here, and they invest in ETFs.
What you're broadly describing is the great caking, and that is very real. All of those laws, if you either read or watch the video of David Rogers Webb, all of the laws in the Western world, they're all footnoted. Every one of those laws are on the books. The ink is dry. And when this thing does come down, that's how banks will try to survive. And that's how brokers and insurance companies are going to try to survive by bailing in customer assets. So it's, like I said, it's 100% real. And if you have money in the system's going to take your capital.
Well, I think that's what's interesting again about that is there are solutions. So now, if I'm a fund or or if I'm a producer, a refiner, or institutional fund manager, and for example, an institutional fund manager may not be sanctioned to own physical. So this is why they invest in ETFs. But now, if you invest in a Western facing SGE free trade zone, gold and silver corridor, 1-to-1 backed physical, 100% backed physical, you can actually access, and this is the thing is that's happening under our noses right now. Now, you can only have that if it is 100% physically backed. It is an auditable exchange inside and siloed, unlike the COMEX, which is siloed in like a casino. It had nothing to do with reality. This is siloed inside physical. Once you enter it, and you enter their ETF, it's 100% physically backed. You can trade out, you can swap, you can do anything you want. Now, these are the people that used to inhabit the COMEX. They're left. They've gone. And if I'm a producer, why would I play that stupid game where they're going to see, I'll tell you what we'll do. We'll fix the price here, and then we'll play them games with you. And hang on, no, I just want to know what is my forward cost? What am I being paid? What is the price? And I want it lock it in. And then I can hedge that. And then it can collateralize that position. So this is the strange thing about it is that these people don't realize the COMEX open interest has vanished, is disappearing into an alternative venue where you can be physically backed.
You're describing the physical side of Shanghai. There is a futures side to Shanghai, And as I understand it, there's close to 30 different groups that have been shut down over the last, since the peak, since the smash. There's 30 groups, and that's, I don't know what the number is. It's over 200 customers have been precluded from trading Shanghai futures because they've broken the rules. And, kudos to you, Andrew. I can remember back in 2010 when you testified in front of the CFTC regarding, position limits and, of course, all the shenanigans that have been going on. There were no repercussions whatsoever from that. As a matter of fact, CFTC came out after a 5-year study on silver and said, "No, nothing to see here. Everything's good." Well, it's clear that that's not the case. I mean, position limits were completely ignored. Millions upon millions of ounces, paper ounces, have been dumped onto COMEX over the years. That there's no silver behind it, there's no gold behind it. However, China is enforcing the rules, and China is going to drag COMEX and drag LBMA upward price wise by forcing them to, if for lack of a better term, lift their skirt up and show that it's a fraud.
You're absolutely right. And my information is very much like you. They stepped in. They were actually pissed off that because the Shanghai Futures Exchange should be the tradable size, the hedging side of your physical market in the SGE. It should actually be, it should actually have a practical level. And so what they've done is they've increased margin limits. They've got rid of all of the. In fact, I understand that there's probably people going to do jail time over there. It wouldn't surprise me. But as you say, there's some serious stuff going on. They slapped it shut because they value the whole system. So what we were just saying a minute ago was really what the PBOC wanted to do was restabilize the functional hedging tool that the Shanghai Futures Exchange was designed to be and got taken advantage of.
Well, isn't that what BRICS is all about anyway? BRICS wants free, fair, and real settlement. They want a real currency. They want a real futures market to their cash market. I have no idea whether this is correct or not, but finance or international finance is a war, if you will. And China understands, if you and I understand that there's a shortage in silver, they understand that there's a shortage in silver. They know more than we do. What they are, what I'm getting at is they, by shutting down these rogue traders in the futures market, they want real markets. They want Mother Nature to take over because they know that Mother Nature turns the Western world upside down without them firing a shot.
Sun Tzu.
Exactly. Yeah, exactly.
Very clever. People forget, Bill, I know we know this, but people forget that it's only been 400 years, and that's tiny in the span of Chinese history. 400 years since silver was Chinese primary mainstay currency. We see these new tariff wars have sparked a move to switch from price suppression to draining cheap silver. They're going all in, stepping in, building up the strategic silver stockpiles. And again, Sun Tzu style, they're currently being drained from its enemies. They are enemies, and they want to remonetize silver. And they've remonetized gold. They're remonetizing silver. Why? This is hell for the West, because they're not positioned for this at all.
Well, because it's a fiat system and it's fractional reserve. It's as simple as that. Basically, what the East wants is Mother Nature to take over and do a complete reset of all assets. And that reset, it makes worthless assets worthless. And when I say worthless assets, fiat's all over the world, credit all over the world, payable in fiat. I had a mentor for years that used to use the term, everything's worth nothing. And the way he explained it was basically fiat currency it's nothing. It's backed by, it's their IOUs, plain and simple. And then the credit markets, the borrowed money, that's worth nothing because it's payable in nothing. And that was what he envisioned, was that when all is said and done, everything financial is worth nothing because it's all denominated in units of nothing, whether it be dollars or euros or yen or British pounds or what have you.